Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
The earnings season for the third quarter of 2019 is at our doorstep, and the banks are the first to report out of the gate. That begins tomorrow, October the 15th, as we're sitting here talking on the 14th with our research director, Shiraz Mian. So, there's a lot going on going into this earnings season.
Sure.
Let's take it one step at a time. Heading into the season, a trend emerged among the banks. Analysts seem to have become more bearish and consistently made downward revisions to the bank estimates. Does that spell trouble for the finance sector this time around?
Yes, it does. It has a positive aspect to it itself, but let's talk about the troubling part. And a big issue with financials in general, with banks in particular, has been interest rates, particularly the gap between the rate at which they lend and at which they borrow being the depositors. So that net interest margin has been very narrow for the last many years, started going up earlier this year, and has again started trending down. So the core banking business in which they lend and take deposits, that's been troubled for a while. Loan portfolios have not been growing that much as well, even though the economy has been okay. And then on the investment banking side, trading, advisory, the M&A advisory and the IPO business has been kind of iffy, not that great. So yes, estimates have been coming down. Profitability for the group has been challenged for a while. There will be the trend in Q3 as well. The positive aspect of that, Terry, is that since expectations are so low, it will not take much from these guys to excite investors. So if loan portfolios grow a little better on the consumer side, on the business side, I think that could serve as catalysts for a number of these stocks.
Well, one thing you said, and we don't really have a scorecard yet because the reports haven't started flowing
That's correct.
out, but you say that this week's lineup of reports by the banks has enough representation from other major sectors in it as well to give us a good flavor of what to expect in this reporting cycle across the board.
It's a very front-end loaded reporting cycle. And in general, we just have a sprinkling of results from other sectors. This time, in this first major week of reporting, we'll have plenty of reports from other sectors. So the IBM and Netflix are reporting too, in addition to the JP Morgan, Citi, Wells Fargo, Goldman Sachs, a bunch of transports, airlines, as well as railroads. So it's a pretty diverse group of companies. And my sense is that the typical like conclusive type of takeaways that we try to get at in the first few weeks of the earnings season, we'll have that by the end of this week.
All right. Well, the S&P 500 is expected to see the first year-on-year decline since 2016. And analysts have already cut Q3 estimates in general and expect a contraction for the quarter. So, is this a trend that you think is going to get worse?
I don't think so, Terry. We all along knew that 2019 was the growth challenge period. The big reason for that was the tough comparisons to last year when profitability was really boosted by that very generous corporate tax cut. So the first half was essentially flat, just barely in positive territory. Q3 is negative, about 5% decline in earnings. Q4 is currently barely in positive territory. I have a chart that I'll show a little later. But I think once we are through with this year, the expectation is for pretty decent growth towards the end of the year, beginning of next year, and then pretty strong growth for 2020 as a whole. In fact, even strong growth in 2021 as well. So the analysts are fairly optimistic for earnings going forward. We just have to cross 2019
Yeah,
first.
we have to get there first.
That's right.
And I'm still hearing reference to an earnings recession out there. Are we in one?
No, we are not. So we had flat earnings in the first half. You rightly pointed out that Q3 is expected to be negative, about 5.1% decline in earnings and about 4% higher revenues. But that's pre-season. So once actual results come in, my sense is that the Q3 final tally, it may be in negative still, but barely negative, so close to the flat line. Even if we do get two back-to-back negative quarters, recession has some real fundamental connotations of tension and stress in the economy. We don't really have that. Revenues are growing, the economy is doing fine, the labor market is doing fine, incomes are going up, and that is not a supportive backdrop for an earnings recession.
So as far as estimating profit growth for Q3, you're looking at down?
It is, yes. The expectation is for negative growth. Let me share. I have okay, so 5.1% decline, yes, on 4.2% higher revenue. That's the expectation. But as I mentioned earlier, actual results tend to be 3 to 5 percentage points better than what is expected at this stage. So it's very possible that we may have a 1 to 2% decline and maybe even a flat line.
We're going to come back to more graphics right after I ask you, are we going to see more evidence of how the trade war between the U.S. and China has weighed on companies?
Yes, yes. There is some direct impact in a number of sectors where the tariff has been levied already, and we've been hearing about that from a number of the trade exposed areas in the last few quarters, and I think we'll hear more of that. There is some positive noise that we are perhaps reaching the end point for the trade dispute and trade uncertainty. But for Q3, it was a live issue for many of these companies, and even those that were not directly affected, like the banks, for example, it'll still have indirect effect. So many of their customers, particularly on the industrial and manufacturing side, they perhaps are not borrowing as much because they have uncertainty about their spending, the spending outlook. So it has implications throughout the economy, and we'll hear about that this earnings season.
And against this entire backdrop that we just discussed, which sectors do you expect to stand out, good or bad, for Q3?
Sure. So I have in this slide, we show that 11 of the 16 Zacks sectors will have negative earnings growth, meaning earnings will be below the same period last year. And as I mentioned in this bullet point, energy, basic materials, technology, and aerospace will have double-digit declines. I do want to focus a little bit on the technology a little later, but let me show you the positive ones too. So 5 have positive earnings growth, barely mid-single digits, as you could see over here. Business services, transportation, utilities, finance, and construction. And this is the technology that I just mentioned earlier is a double-digit decliner, 11.2% earnings decline for technology in Q3. And as you could see, Terry, the sector has not been doing that well over the last few quarters too. As you could see, in the first half too, earnings were down. And even for the last quarter of this year, a fourth Q, it's expected to be down 3%. And in this next slide, I share why is the technology feeling this pain. And a big reason for that, the chart here is showing the semiconductor industry, which accounts for about 1/6 of the tech sector's earnings. And as you could see in that orange column, the orange bar, 35% lower earnings for semiconductors in Q3 from the same period last year. This pain is expected to persist through the final quarter of the year as well, and then comparisons become easier. The fundamental outlook is expected to get easier too. The trade issue is expected to be less of a drag for this space too. And in addition to the semiconductors, a number of these other, like Apple has tough comparisons. There's a number of other players too. So that the tech stands out, particularly on the negative side in terms of growth.
But technology is a bellwether sector.
It is.
You're telling me this is not worrisome to you?
It is. The parts of tech where you have stronger growth is more on the software and services side. The hardware and the machinery part has been struggling for a while, and the trade uncertainty, and as a result, less capital spending by companies has not been helpful to this particular development on the tech front. But tech is a very broad area.
Yeah.
Pockets of tech are doing very good, and pockets are really in pain, as we are showing here in the chip space.
But you said it before, I heard you, there's better earnings news yet to come.
Absolutely, and there is. And let me share this slide. And we briefly discussed this when you brought up the recession word. So as you could see, 5.1% decline in this quarter on 4.2% higher revenues. For the last quarter, we have 0.5% growth now. And then look at the first quarter of 2020. Now you would say the first quarter of 2020 is way over there.
Right.
You have to cross the winter to get to the first quarter of 2020, but you can at least look forward to good positive growth in that first part of the year.
But that will reflect holiday time too.
That will reflect holiday time too. And if I step back from the quarterly stuff and show you the annual picture, you see 2019, 0.6% earnings decline in this chart. And that's because how big the growth in 2018 was. You see 23% earnings growth in 2018. Anything in comparison to that would be difficult. So the fact that earnings are essentially flat from the all-time record 2018 level is a pretty strong performance in my judgment. And then you have 9.5% growth expected in 2020, almost 10% growth expected in 2021. So the stuff on the horizon is a lot sunnier and a lot brighter. So don't feel bad.
Again, getting there is the problem.
That is the issue.
All right. Well, we're going to check in with you a few times more during this reporting season. And in the meantime, if you want to keep tabs on the written commentary on earnings trends and the earnings outlook that Shiraz pens by his own hand, get on over to Zacks.com. You'll find it accessible right near the bottom, about 2/3 of the way down of the homepage. With Shiraz, I'm Terry Ruffalo.